Friends, welcome back to our channel OMSAI Bhojanapalli.
Point number 1. Basics in options. Learning objectives. Point number 1. Basics in options. Should we discuss completed? Completed. Basics in options completed. Next. Point number 2. Option strategies. Point number 2. Option strategies. Point number 3. Point number 3. Understanding. Point number 3. Understanding concepts of. Point number 3. Understanding the concepts of short selling. Understanding the concepts of short selling and continuous compounding. Understanding the concepts of short selling and continuous compounding. Concepts of short selling and continuous compounding. Short selling should we understand? Already understood. Where we discuss? In the portfolio. In which slot? Arbitrage pricing theory. Remember or not? I gave you the printed notes for the short selling if you remember correctly. Right? No. Next, point number 3 or 4? 4. Theoretical boundaries. Point number 4. Theoretical boundaries for a European call option and put option. Theoretical boundaries for a European call option and put option. Theoretical boundaries for an European call option and put option. For an European call option and put option. Put a hyphen and write maximum and minimum values. Put a hyphen and write maximum and minimum values of call and put. Put a hyphen and write maximum and minimum values of call and put. Maximum and minimum values of call and put. Next, point number 3 or 4? 5. Point number 5. Put call parity equation. Put call parity. Put hyphen call parity. We have interest rate parity and IFM and all. Like that is a very backbone of the entire chapter. Put call parity equation. Right? Put call parity equation. Put dash call parity equation. Any now? Put call parity equation and arbitrage. Put call parity equation and arbitrage. Put call parity equation and arbitrage. And arbitrage. Point number 6. Point number 6. Option valuation models. Point number 6. Option valuation models. Point number 6. Option valuation models. In the right A. In the right A. Binomial model. Spelling BINOMIAL. Binomial model. Binomial model. Binomial model. B. Risk neutralization model. Risk neutralization model. Go home and check the dictionary. English risk. Or having the workbook also. Risk neutralization model. RISK. Risk neutralization model. Neutralize. You have heard or not? Risk neutralization model. Risk neutralization model. Point C. Point C. Two-period binomial model. Two-period binomial model. Two-period binomial model. Two-period binomial model. Point C or D? Point D. Black Scholes. This is spelling and tell you. BLACK. Black Scholes. SCHOLES. Black Scholes. Black Scholes model. D is Black-Scholes model. Blackschles, Black-Scholes model. Stop talking, please. Next, point number 6 or 7 or 8. Point number 7, please. Discussion of all the above concepts. Point number 7. Discussion of all the above concepts. Once again. Discussion of all the above concepts. Once again. Discussion of all the above concepts. Once again. For a dividend paying share. Discussion of all the above concepts. Once again. For a dividend paying stock. Discussion of all the above concepts once again for a dividend paying stock. For a dividend paying stock. Let us again maximum minimum value, put call parity, everything will come once again for a dividend paying stock. Next, can I proceed? Next, point number 7 or 8? 8. Discussion of all the above concepts once again. Point 8. Discussion of all the above concepts once again. Discussion of all the above concepts once again for an American option. Discussion of all the above concepts once again for an American option. That means still know what they discuss is for what? European option. Okay. Discussion of all the above concepts once again for an American option. Discussion of all the above concepts once again for an American option. This is the agenda for this particular chapter called as options. One of the big chapter in the syllabus. As big as you can say, almost as big as a portfolio or a capital budgeting. Can we start or not? Now, please. Now we are going to discuss the second slot called as what? Option strategy. Again, very, very easy. Only when you start the valuation, the entire chapter takes a very different angle. Till then, very simple. Give the heading. Part 2, option strategies. So whatever we discussed is part 1, called as what? Basics in option, right? Part 2, option strategies. Please stop talking. Part 2, option strategies. Part 2, option strategies. Okay, right there. Learning objectives. Adukulla we are having some objectives to be learned here. Learning objectives. Please. Learning objectives. Point number 1. Long straddle. Strategy names I am telling. Long straddle. STRADDLE. Long straddle. If you can look at question number 8, spelling will be there. Long straddle. Long straddle. Number 2. Short straddle. Short straddle. Short straddle. STRADDLE. Short straddle. Can I proceed? Point number 3. Long strangle. Long strangle. Long strangle. STRANGLE. Long strangle. Strangle. You are going to strangle the neck or not? So long strangle. Point number 4. Please. Short strangle. Stop talking. Point number 4. Short strangle. Point number 5. Bull spread. Bull spread with call option. Bull spread with call option. Point number 5. Bull spread with call option. Point number 6. Bull spread with put option. Point number 6. Bull spread with put option. Point number 7. Bear spread with call option. Bear spread with call option. People are bullish and bearish. Yes or no? So bear spread with call option. Bear spread with call option. Point number 7 or 8? 8. Bear spread with put option. Bear spread with put option. Bear spread with put option. Point number 9. Butterfly spread. Point number 9, butterfly spread. Point number 9, butterfly spread. There are some more strategies for which you don't do problems. I'll give you the strategies alone at the end of this particular discussion. Okay. Now, nothing great. All are simple issues. Having different mix of call and put. That's all. That is very popularly followed in the markets while doing the derivatives trading. What are you doing? Let us straight away start doing the problems in this regard. Every strategy will be saying how the payoff behaves. Please understand that I want to tell something about the markets now and then proceed. But I won't put any quotations and all. I'll show you the live quotation of options, how to read them at the end of this particular chapter, because now we are discussing everything as an independent individual contracts. I don't know now. And the best way and the right way to understand that chapter, these contracts can be traded in the share market or the stock market. That can be discussed in the later stage of this chapter. But I just want to make you understand one idea before I start discussing these strategies. Okay, see. In BSc as well as what NSC, you can go and visit those sites. That is always useful. Just to have, that is, if you're not already trading it, no need to trade to go into those sites. You can also go and see what is happening. That's what I'm saying. I'll always only see happening. I don't trade. Okay. So afraid to put money. So always one can go and what, visit those sites, see what is happening. Always in the BSc or the NSC sites and all, we'll be having 3 segments. We'll be having what? 3 segments. One is the share trading segment, where you can buy and sell the shares. I can give a buy order for a TCS share. I can sell an Axis Bank share or a Kingfisher Airlines. Yesterday only reported losses 860 crores. I can sell. Are they better? Yeah, okay. So losses of about 860, I can sell that. If I have that share, somebody is willing to buy, what I can do? Sell those shares like that. In share segment will be what? Buying and selling shares. Yes or no? And give a buy order and give what? A sell order. We're buying and selling shares. Are you following us? Now, another segment is the bond segment, fixed income security segment, where bills are traded. Okay, T-bills, yeah, Reliance bond, like the bonds will be what traded. People can buy and sell what? Bond in the stock exchange. These are listed bonds. Are you following us? Now, like that, one more segment is there. That's called as what? F&O segment. What segment? F&O segment. We call as derivative segment, where futures as well as what? Options are traded. There's a separate site for futures. There's a separate site for what? Options. They say futures and option contracts are what? Traded. These contracts are what? Bought and sold. In what segment they are? F&O segment. Respond. Yes or no? Now, see. Very simple. I go to a share segment. Give a buy order. That is, 2 orders, na? Buy order and then what? Sell order. I give a buy order. I give what? A buy order for TCS shares. What is that I have done? I have purchased a TCS share. Yes or no? What have I done here? I have purchased what? TCS share. I go to the share segment, give a sell order for Infosys share. What I have done? I have sold the Infosys share. Easily understanding the transaction. Yes or no? No. See, I go to the bond section, give a buy order for Reliance perpetual bond. What I have done? I purchase a bond. I give a sell order. What I'll do? I have sold the bond. Yes or no? No. Like that. I go to the derivative segment. Forget futures. We're not yet discussed. We go to what? The option. Okay. How TCS share is trading, like that, TCS option also will be trading. Yes, and go and see the quotation. We'll be having what? A TCS option also. Now, in that, TCS option is trading. For example, the option segment alone, they give the details of the option contract. Okay, 3 months TCS option contract maturing on, say what I'm saying, this is what month here? Oh, okay, maturing on what? Say July. Maturing on what? Or number here? Or say maturing on what? July. Okay. At a strike price or so much. They give the strike price, maturity date, etc. They are giving. Is trading today at 6 rupees. Today at what? 6 rupees. Tell me what are 6 rupees? Premium. It is what a premium. If I give a buy order for 6 rupees, if I give a buy order for what? 6 rupees, that means what I'll do? I am purchasing the option by paying what? 6 rupees premium. Who is a purchaser of an option? Holder. Remember? Yes or no? Now, if I give a sell order of the option for how much rupees? 6 rupees. When I sell for 6 rupees, I get what? 6 rupees premium. I'm going to be what? The writer of an option. Yes or no? So, how I can buy and sell a TCS share? I can buy and sell what? A TCS option. And buy and sell what? A TCS option. How the share is traded? The option on the share is also what? Traded. For the share, the price is share price. For the option, the price is what? Premium. Yes or no? Are you following what I'm saying? I can give a buy order for 6 and give a sell order for what? 6 rupees. The share is traded, the option is trading at a 6 rupees premium. Now, if I buy the option by paying 6 rupees premium, I am said to be what? Holder of the option. If I sell the option for what? 6 rupees premium, I am said to be what? A writer of an option. Respond yes or no? Now, this TCS shares, premium 6 rupees, I can buy a call option as well as what? Put option. There also have to specify whether I want to go for a TCS call option buying or what? Put option buying. Both will be having different premium. Call option premium suppose is 6 rupees. Now, put can be having a premium how much rupees? 4 rupees. There you should be selecting properly what option you should buy. Whether it is a TCS call or what? A TCS put option. If you are buying a call option, you are buying a right to buy. You are buying a put option, you are buying a right to sell. Everybody, are you following? Confusion, clarity. Now, very simple. I can go to the option segment. I can either give a buy order or sell order. I can give a buy order for any two of the options. What are two options? Call option, put option. Anyhow, when I buy an option, I am going to become what? Holder of an option. For which, what is the price at which I buy the option? Premium. When I give a sell order, I can give the sell order for what? Call option or put option. I can give the sell order for call option or put option. At what price? The call option, put option, premium. When I give a sell order, I become what? A writer. So buyer of an option is holder and seller of an option is what? A writer. I am a buyer of a call option. I can be a buyer of what? Put option. I can be a seller of a call option. Also seller of what? Put option. Everybody able to understand the scheme or not? No. More about the option quotations and all, we'll be discussing towards the end of the chapter. Just I want you to understand that how I can buy and sell shares and also buy and sell the options on the share. There's a ready-made market available for that is what I wanted to convey here. Can we start on now? Let's start doing the problems. See, what we're going to do here is nothing great. A person need not buy only call option, need not buy only put option, need not sell only call option, need not sell only put option. You can take multiple positions simultaneously, yes or no? I can buy a TCS call, I can buy a TCS put immediately, yes or no? Yes or no? Similarly, I can buy a TCS call and I can also what? Sell a TCS call. It is possible that I can be a holder of 2 calls. I can be a holder of what? 2 puts. I can be a writer of 2 calls, writer of 2 puts, holder, writer. Different combinations are possible or not? Now, there are some famous combinations which are followed in what? Market to make the profit with some ranges. Okay, those are all we call as option strategies. Even one can follow these strategies in the market itself and make a payoff as promised by this particular diagrams. Are you following what I'm saying? So these strategies are called as what? Option strategies, where a person takes multiple positions. Sorry, he is not only a holder, not only what? Writer, he can hold as well as what? Write. He can go for call as well as what? Put option. When he takes a multiple position, how his payoff looks like will be discussed in this slot called as what? Option strategies. So many strategies are there. We are discussing only few of them here in our classroom that may be required for the examination purpose. Can we start doing it or not? No. Let's start with the first strategy called as what? Stranded. Okay, please. Can we switch on the AC? Okay. Consider a call and a put option, please. Consider a call and a put option on the same underlying stock Both options have an exercise price of 75. The call cost rupees 5 and the put cost rupees 4. If you buy both the call and put, what is the position called? Complete the following table showing the value and payoff at expiration. They are given you stock prices from 50 rupees to 90 rupees is the question. Okay, now please go through the question. Simple English only, you should be able to understand it. Read the question before I start with the solution. Shall I start up? No. We are discussing a strategy called as straddle. A strategy called as what? Straddle. Very simple. In a straddle, a person is going to buy both call option and put option. So it should be call option and put option. Can I have a call option on TCS shares and put option on Infosys shares? No. It should be call option and put option on what? The same underlying asset. The asset should be what? Same underlying asset. Can I go for a call option with a strike price of 100 and can I go for a put option with a strike price of 80? No. Because options can have different strike prices or not, contract. So it is no. The call and put should be having what? Same strike price. So when I am purchasing a call option, when I am purchasing a put option, I am holding a call option, I am holding a put option on what? Same underlying asset. For what? Same maturity. That I forgot. The call option also should expire after 3 months. The put should also be expiring at what? 3 months. So when I hold a call option and put option with the same underlying asset, having what? Same maturity, having what? Same strike price, my portfolio. It is a portfolio or not? Why portfolio? Combination of assets. So I am going to have what? Portfolio. That portfolio is called as what? Straddle. It is called as what? Straddle. What is straddle here? It is a portfolio having what? Multiple options. What are the two options? Call option, put option. The call and put is on different stocks. Same stock. Same stock. Different maturity base, same maturity base, same maturity base, having different strike price, same strike price, same strike. Everything, all terms are same, except this one is a right to buy, and is what? Right to sell. No. That's the portfolio we call as what? Straddle. Up to this following or not? Now, see, I can have two positions. In any market, one can either go long or what? Go short. The word long means buy. The word short means what? Sell. There should be always understood. What is the meaning of long? Buying. What is the meaning of short here? Selling. Okay. Now, if I hold a call, hold a put. If I want, hold a call option, hold a put option. Holding means selling or buying? Buying. Option holding means option buying. If I have bought the call option, if I have bought the put option, hold the call, hold the put on the same asset, same strike price, same term, I am said to be holding the portfolio or not. So I am said to be having what? Long straddle. It is called as what? Long straddle. Suppose I have written a call, I have written a put. I have sold a call, I have sold a put on what? Same asset, same strike price, on same maturity period. I am said to be having what? A short straddle. Other strategy. Yes or no? Now, tell me, what is a straddle here? It should be a call and put option. On what asset? Same asset. For what price? Same strike price. For what maturity period? Same maturity period. He is called as what? Straddle. The portfolio is called as what? Straddle. That straddle you can either what? Hold. You also what? Sell. So or write, okay. So holding a straddle is what? Holding a call, holding put. And writing a straddle means what? Writing a call, writing a put. Yes or no? No. A holder of the straddle will have to pay premium for call and put. Yes or no? A writer of a straddle, we want a receiving premium for call and put. Everybody accept or no? Can I proceed further? No. So let us do this particular problem and see how the payoff behaves. It is not such a great deal, very, very simple issue only. Can I start or not? Now, please tell me this problem. In this problem, question number E, I am purchasing collar, selling collar. I am purchasing a, selling a. Tell me. I am purchasing a, selling a. Purchasing, you buy, yes or no? You buy means what? Purchasing. I am both things are there, not purchasing, selling. I am buying what? Call option and put option. So I am buying a call, I am buying a put. I am buying a call, I am buying a put. I am going to hold a call, I am going to hold the put option. Yes or no? I buy the call option by paying how much premium? 5 rupees. I buy the put option paying how much premium? 4 rupees. Told me how much I pay premium? 9 rupees I pay premium to purchase this straddle. Yes or no? And the call and put is having how much strike price? 75. Is going to be how much strike price? 75. This all the details given. They say what is the straddle going to give me are the following FSPs. This is the question. Are you understanding the question or not? Now we can write the introduction notes later. Let us write the solution first and then go for the notes here. Okay. Can I do it together or not? Now, straddle. Don't copy. Just see. Straddle is a situation where the holder holds what? Call and put on the same underlying asset, same strike price, same term. So underlying asset same, strike price same, term also what? Same. Can I proceed or not? Now. Holder's point of view, it is what? Long straddle. Writer's point of view is what? Short straddle. Everybody, can I proceed or not? No. Okay, let us do it together. Question number A. And question number A. Open the following columns quickly, please. Shall I start up? Shall we start or not? No. Let's start one by one. Take the first FSB or the first FSB 50. Other stock price on expiration. Expiration means what? Maturity. On date of maturity, stock price is called as what? Future spot price on FSP. Okay, 50. Please. Don't be lazy. Think and then answer. You are a holder of a call and what? Holder of a put. Who will decide? You will decide. Other party. We are going to decide because we are going to be the holder, right or not? Now, tell me. Now, you are a holder of a call with a strike price of how much rupee? 75. All of you together, don't answer. Say before me or after me, 12 let us answer. 75 rupees is what? The strike price. I have a right to buy at 75 a share. Is what the what? 50. Will I exercise or lapse or lapse? As a holder of the call is what? Worthless. It is zero for me. Innappa right? Now. For the call, tell me I am receiving premium, paying. How much I pay premium? 5 rupees. I pay premium of -5. What is the payoff from the call option? -5. I hold only call, I hold call and put, call and put. I'm having put option or not? Tell me, I have a right to sell at what? 75. A share worth what? 50. Will I exercise, labs, exercise. I'll exercise and sell the share at 75. Worth what? 50. What is the put giving me? 25 rupees. So the value of put is 25. The put gives me 25. Value of put is 25. Tell me. For this, I am paying premium or receiving premium? Paying. How much I am paying premium? 4 rupees. As a put holder, I pay premium for put 4 rupees. Now, tell me, what is a put giving me? 21. Now, if I hold put alone, my payoff is what? 21. If I hold call alone, my payoff is what? -5. I am holding call, put, portfolio. Name the portfolio. Straddle. The straddle payoff is 21 minus 5 gives you what? 16. It gives you how much rupees? 16 rupees. Everybody understanding it or not? Is the payoff of the straddle strategy. Can I proceed or not? Now, next step. FSP is what? 65. FSP is 65. You have a right to buy at 75, a share worth what? 65. Exercise or lab? Lab. What is the worth of the call? 0. For a 0 value call, you pay how much premium? 5. What the pay of the call gives you? -5. Put will you exercise, labs, exercise. Exercise, labs, exercise. I have a right to sell at 75. A share what? 65. What is the value of the put? 10. What the premium? -4. What is the value of the pay for the put option? 6. Put alone if I hold, I get safe. Call alone if I hold, I have what? -5. I hold both. What is straddle payoff? 1. The payoff of the straddle is 1. Next, 70. I have a right to buy at 75. A share what? 70. Exercise or labs are lab. Value is 0. Premium paid -5. Payoff is -5. I have a right to sell at 75. A share what? 70. Exercise and labs are exercise. What is the value? 5. What is the premium paid? -4. What is the payoff? 1. The straddle payoff is -5 plus 1 gives you what? -4. The straddle payoff is -5 plus 1 gives you -4. Next is what? 75. Call will be exercised on? No. Now, I have a right to buy at 75. I what do what? 75. What? Nothing. 0. What the premium? -5. What the payoff? -5. He is put what investing on order. Now, it is also what? 0. Right to sell at 75. Yes, I what? 75. The put what is what? 0. Premium paid -4. Put payoff -4. The portfolio payoff is how much here? -9. The portfolio payoff is -9. Up to this, are you following? Now, next is 80. It is what? 80. Will I exercise call labs? Exercise. Why? I have a right to buy at 75. A share what? 80. Exercise and what is the worth of the call? 5. What the premium paid? 5. What the payoff? 0. Put will be exercise or labs? Labs. What the worth of the put? 0. Premium paid? -4. What is the payoff? -4. The portfolio payoff is what? -4. The portfolio payoff is -4. I think you are all understanding. Now, next step. 85. Call exercise labs exercise. Because I have a right to buy at 75. Yes, I have what? 85. What is the worth of the call? 10. What is the premium paid? 5. Call payoff? 5. Put will be exercised on labs? Labs. What is the value? 0. Premium is what? -4. What is the payoff? -4. Tell me the net payoff of the strategy is how much? 1 rupee. Net payoff is 1. Please. Last is what? 90. Call exercise or labs exercise. Right to buy at 75. A share worth what? 90. What is the profit for me? 15. What is the premium paid? 5. What is the payoff of the call option? 10. Put is what? Worthless. What is the premium paid? -4. Put payoff is -4. Portfolio payoff is 6. Up to 90 only question asked now? No. Is the answer for this particular problem? Respond yes or no. Can I proceed further? No. See. Please, shh. Stop talking. Can I proceed? This is how the straddle diagram looks like. It is a long straddle. Now, this is x-axis, which you call as what? FSP. As usual, y-axis is what? Payoff. Is payoff from call, putta, call, unputta, call, unput. It's a straddle payoff. Respond yes or no. Now, this number can be written as minus 9. It's going to be what? Minus 9. Please. What is the strike price? Tell me. The strike price is 75. That is going to be the FSP here. I have here. Okay. What is 75 minus 9? Please say what is 75 minus 9? 66. What is 75 plus 9? 84. Now, look at this. Understand this. If FSP falls, put saves me. I am a holder of a call. I am a holder of a put. Is or no? Now, if the future spot price reduces, I am happy as what? A put holder. Is or no? Put is a savior for me. Right or not? If the FSP increases, I make profit through what? Call option. Yes or no? So I will be happy whether the FSP increases or what? Decreases. I will be very unhappy only when the FSP is near to strike price. Remember? I want my FSP to be what? Far away from my strike price, either on left hand side or on what? Right hand side. Everybody following what I am saying? May I respond? Yeah? Now, understand that for this portfolio, I am paying a premium of 9 rupees. I pay 5 rupees premium for the call and 4 rupees premium for what? Put option. I pay a 9 rupees premium. Accepted that? This 9 rupees premium should be recovered by my put option at lower FSP, be recovered by my what? Call option at higher FSP. So no. Now, tell me, what is the break-even FSP for a put option? Formula. What is the break-even put option here? Strike price minus premium. What is strike price? 75. The 75 minus what premium? Call and put, because this has got the due to recover what? Both the premium. So 75 minus what? 9, 66. At 66, my payoff will be 0. Let us check it. Very simple here. FSP is 66. Now tell me, as a call holder, will he exercise or lapse? Lapse. Call is what? 0. As a put holder, will he exercise or lapse? Exercise. I have a right to sell at 75. Yes, I want what? 66. So, call value 0, put value what? 9. The straddle gives me 9 rupees value. Yes or no? And how much I pay as premium? 9 rupees. My payoff is 0. Yes or no? No. If the FSP is below 66, I will be making a profit or loss of profit, because I get profit through put holding. Yes or no? Clarity? Now, see. Suppose at higher FSP, who is my savior? Call option. Now, what is the break-even FSP for call option? Strike price plus premium. What is strike price? 75. What is premium? 9. If you how much is here? 84. Now, at the 84, what is straddle payoff? 0. Because at 84, will I exercise put option up? No. Put is what the what? 0. Will I exercise call option up? Yes. I have a right to buy at 75. Yes, share worth how much? 84. What is my amount? 9. 9 is a straddle value, and how much I pay as premium? 9. The payoff is what? 0. Above 84, I'll start to make what? Profit. So above 84 profit, and below 60 is what? Profit. So now, this profit is due to what? Call holding, and this profit is due to what? Put holding. Between 66 and 84, I'll be suffering loss. The maximum loss is at what? Strike price of 75, where it is going to be equal to the premium pay. So no. Right or not? So because at 75, neither call saves me, neither put saves me. What happens here? Entire premium is gone. So the maximum loss of how much? Minus 9 occurs at what? 75. Then the loss keeps on reducing and reaches what? 66. It becomes 0 due to put. It reaches at 0 at what? 84. And then begins to make profit. Is a diagram for a straddle payoff. Right or not? Full clarity. Now look at this. See. Okay. This is, I think, asking the question now. can write this in the workbook itself, no need to copy it. See, romba simple here. That is value of my position and then what? Payoff. Position value na without considering premium. Payoff is what? After considering premium. Now, 50 means the position value is how much here? 25. How you got 25? VC plus what? VP. 0 plus 25. Right now, 65 is going to be what? 10 and so on. And the payoff is always 9 rupees lesser. Yes or no? Because premium is going to be how much rupees here? 9 rupees. 25 minus 9, 16 and so on. I think you are following or not? Just a summary. Now, look at this. This is important. Situation and then what? Status. You all answer. FSP less than what? 66. How I got 66? Formula. Strike price minus premium. What it is? Put break even FSP. Yes or no? No. What is that here? 66. Less than 66, what is a standard holder going to have? Profit. He is going to earn profit due to what? Put holding. Yes or no? No. FSP greater than 74, 84. How I got 84? 75 plus 9. Profit and loss of profit. Due to what? Call holding. FSP between what? 66 to 84. What happened? Loss. What is the maximum loss? 9. What is the maximum loss here? 9. When it happens? When FSP is equal to strike price or premium. Response yes or no. Is the analysis of the behavior of the payoffs of this standard strategy. Can I say? No. This is a diagram which has been drawn by us for our actual number. This is the Excel sheet diagram. Everybody following or not? No. With this we complete this particular problem. Clarity irukka? No. So what you do is, I think you have copied up to this. No. What you do is, go to the workbook and copy the next slide. Don't copy in the notebook. Copy in what? Workbook quickly the next slide. Space given up a workbook la? Okay. Please copy in the workbook the next slide. You can see write the position value. Payoff is nothing but position value minus what? 9 rupees premium. Okay. Write it down quickly. The first column, position value is the value the straddle gives me. For that value, I have to pay what? The premium. The net profit which I earn is the payoff. Okay. Finish copying up. See what happened is, at 75, neither put nor call gave me any value. The stand is having how much value? 0 value. So entire 9 rupees gone. Everybody saw no? No. Below that and above that, the loss is also less. It slowly goes towards the profit making FSP. Can I proceed or not? No. Finish copying up. Next. Stop talking, please. Finish copying up. Finish coming up. Last rate maximum rupees 9 when FSP is equal to what? Strike price. Loss maximum 9 when FSP is equal to strike price. Maximum 9 when FSP is equal to strike price. FSP is equal to strike price. Shall I proceed further? Now, draw this particular diagram. Using long straddle. Copy this, long straddle. Don't take too much time. One y-axis, one x-axis. Put a V. Where the V cuts the x-axis, write 66, 84. The peak write as 75. FSP payoff. Finish copying, huh? Please. Can I proceed above? Now. With this we complete the problem number 8 called as what? Long straddle. Now, how I can be a holder and writer of a call option and put option? So how I can be a holder of a call option and put option? I can even be what? Writer of the call option put option. That can be another party for me. Yes or no? We can be a short portion, right or not? No. There's another person who is writing a call, writing a put for a strike price of what? 75 and receiving 9 rupees premium. Is it possible or not? Now, let's see what happens to the other party in the next problem. Can I proceed further? Now. Now. Take question number 9. Take question number 9. Please. All are self-evident here. Okay, straddle. Write down notes. Write down notes. Point number 1. Straddle is a strategy where straddle is a strategy where a person holds call and put option. Strategy is a strategy where a person holds call and put option. A person holds call and put option on the same underlying asset. A person holds call and put option on the same underlying asset. On the same underlying asset for the same maturity period. For the same maturity period at the same strike price. For the same maturity period at the same strike price. At the same strike price. Yes or no? Next. Point number 1 or 2? 2. If he holds the above call and put option, if he holds the above call and put option, if he holds the above call and put option, his position is called, if he holds the above call and put option, his position is called long straddle. His position is called long straddle. Full stop. Continue. If he writes the above call and put option, if he writes the above call and put option, his position is called what? Short straddle. His position is called short straddle. His position is called short straddle. More about long straddle we have just seen in the last problem itself with the diagram. Can I proceed to the next problem or not? Now, take question number 9. Take question number 9. Mr. A wrote, please. Participate. Mr. A wrote a call of a strike price of 80 for a premium of 5, expiration period of 3 months. He also has written on the same day a put for the same stock at a strike price of 80 for a premium of 4. Compute the position value and pay off for the writer for the future spot price between 65 and 95 with an interval of 5. Can we start or not? No. Please. All these sums, the risk is you become immune to numbers, you may not think an answer, but be alert for each and every sum, how it is being answered. Now tell me, A is a holder or writer? Writer of a call or put or call and put or? Call and put on different stock or same stock or? Same stock. Different maturity or same maturity or? Same maturity. At different strike price or same strike price? Same strike price. He is said to be holding what? Short straddle portfolio. Respond yes or no? No. What is the premium is paying for the call option? 5. What the premium is paying for the put option? Sorry. The premium is receiving for the call option is 5. And receiving for the put option is what? 4. He totally receiving how much premium? 9 rupees. What the strike price? 80. Respond yes or no? Who will decide? A will decide, other party. The A is a writer. You have to only what? Obey when the other party decides. Can we start or not? No. Always when I ask exercise or not, tell from the other party's view. Always think from the holder's view for making a decision, and the writer obeys in the opposite sign. Are you following what I am saying? Can I proceed further? No. Open the columns, please. Question number 9. Please open the columns quickly before you start doing the solution together. Finish opening the columns or not? Can I start doing it together? Let's start one by one. Everybody think and tell me. First is what? 65. What is the strike price? So what is the strike price? 80. Now, holder of the call will exercise a lapse or lapse. He has a right to buy at 80. His share worth only what? 65. The holder will lapse. So for me the value is what? 0. The value is 0. I pay premium or receive premium, receive. How much premium? 5 rupees. The payoff is 5. Put option holder will exercise put or lapse or exercise. He has a right to sell at 80. He has share worth what? 65. He makes how much profit? 15. I have how much loss? Minus 15. The value I put for me is minus 15. How much premium will I receive here? 4. What the payoff? Minus 11. Tell me, the straddle payoff is minus 11 plus 5 gives you minus 6. Minus 6. 70. Will the call holder exercise a lapse or lapse? For me the call is what? 0. What is the premium I receive? 5. What the payoff? 5. Will the put holder exercise a lapse or exercise? He will sell to me at 30, a share worth only what? 70. For him a profit of 10, for me a loss of what? Minus 10. What the premium received? 4. What the payoff? Minus 6. What is minus 6 plus 5? Minus 1. It is minus 1. 75. Will the holder exercise a lapse or lapse? What the value of a call? 0. Premium is 5. What the payoff? 5. Will the put holder exercise or lapse? Exercise. He exercises and sells to me at 80. A share worth only what? 75. For him 5 rupees value. For me what? Minus 5. What the premium? 4. The number is minus 1. Tell me 5 minus, that is going to be what here? 4. 5 minus 1 is 4. Next is what? 80. Next is 80. When the holder of call exercise and lapse are lapse. Indifferent. It's going to be what? 0. What the premium received? 5. What the payoff? 5. With the put holder also what? Lapse. Right to sell at 80. A share worth 80 no? Lapse. What is the premium? 4. What the premium received? 4. My payoff is how much here? 9 rupees. Payoff is 9 rupees. 85. Will the call holder exercise? Yes. He'll buy from me at 80. A share worth what? 85. For him the profit is 5. For me the loss is what? Minus 5. Premium is 5. Payoff is 0. Will the put holder exercise and lapse are lapse. Value is 0. Premium is 4. Payoff is 4. Straddle payoff is 0 plus 4, 4. Can I proceed? 90. Will the call holder exercise and lapse? Exercise. He'll buy from me at 80. A share worth 90. He gains 10. I lose 10. What is the premium receive? 5. The net payoff is minus 5. Put holder exercise and lapse? Lapse. What is the value? 0. Premium received? 4. Payoff is 4. The net payoff is minus 1. Net payoff is minus 1. Next, 95. Will the call holder exercise or lapse? Exercise. What is going to be his payoff? 15. My payoff? Minus 15. Premium, how much received? 5. What is the payoff net? Minus 10. Put will exercise or will he exercise or lapse? Lapse. Put value 0. Premium received 4. The payoff is 4. Minus 10 plus 4 gives you what? Minus 6. Is the answer for this particular sum. Respond. Are you all following or not? Yes or no? Now, next. Just quickly tell me, how will the diagram look like? Inverted V. It becomes what? It becomes like a A. It becomes like what? A. It is V earlier. It becomes what? Inverted V in case of a short straddle. Remember, right or not? Now, can do it together? Right now. Next. Diagram. Right, diagram. You should tell me all the numbers in the diagram. We'll do it together. Okay, draw the diagram. Now, we have y-axis, which is what? Payoff. It is what? Future FSP. Okay. This is FSP and this is what? Payoff. Okay. Now, how it look like a inverted V or something like what? A it looks like. Okay. Shall I proceed or not? Now, I want the number. This is the maximum pay. How much it is here? 9. The writer earns maximum the premium 9. This is what? 0. My question is, when the payoff will be 9, when the FSP is what? 80. At 80 the payoff is 9. Now, below this, above this, I have to find out break-even FSP or not. What's the break-even FSP for a put option? Strike price minus premium. What is 80 minus 9? This is 71. And 80 plus 9 is how much here? 89. 71 and then 89. Now, when FSP is 71, please tell me, when FSP is 71, will the call holder exercise or lapse? Soluppa. I want a participation. When FSP is 71, when the call holder exercise and lapse are lapse, he has a right to buy at 80, the share worth what? 71. So he will be lapsing it. The call value is 0. Will put holder exercise and lapse are exercise. He has a right to sell at 80, a share worth what? 71. He makes a 9 rupees profit. I make what? 9 rupees loss. So the straddle gives me 9 rupees loss. I receive what? 9 rupees premium. My payoff is 0. Is or no? Below 71, I make a profit or loss or loss. Why I make a loss below 71? Put writing gives me what? A loss. Yes or no? Now, come to the 89. At 89, call will be exercise or lapse or exercise. The holder has a right to buy at 80. A share worth what? 89. For him, 9 rupees profit. For me, what? 9 rupees loss. Put will be what? Lapse. So for me, 9 rupees loss. Premium is how much? 9 rupees. The payoff is what? 0. For any FSP above 89, I'll be making what? Losses. Why I make a loss? Due to call writing. Between 71 to 89, this is going to give me a profit. The maximum profit will be how much rupees here? 9 rupees. When the FSP is equal to what? 75. FSP is equal to 80. Is the answer for this particular sum. Respond. Are you following? How it behaves over the different ranges of FSPs or not? No, please. Okay, copy this in the, I think you don't have the space in workbook now. Now copy this quickly. Position value and then payoff of expiration. You can write the position value negative. Don't write it because I did not write it negative because always writer position value is what? Negative. Holder will be having what? Positive. Now holder cannot have a negative position value because if it is opposite, it will be allowing you to lapse. Yes or no? No. So since I am doing for a writer, I cannot write minus. You want to also write as minus 15, minus 10, minus 5, minus 5, minus 10, minus 15. Write the position value. Copy it. Finish copying up. Finish copying or not? Shall I proceed? So copy this quickly. Situation, status. Finished up? See, 2 more sums you have to complete today. That's target. Okay, now, please. Stop talking, please. Shall I proceed? No. Profit maximum 9. Write down when FSP is equal to what? Strike price. Profit maximum 9 when FSP is equal to strike price. When FSP is equal to strike price. When FSP is equal to strike price. Shall I proceed to the next strategy here? Now, we have completed 2 strategies, namely what? Long straddle and then what? Short straddle. Listen here. What is a straddle? Asset same. That is a call and put option on what? Same underlying asset. Same strike price, same maturity date. If I hold such a column board, I am said to be having a long straddle. If I write such a column board, I am said to be having what? A short straddle. The diagram will never change. For the diagram, say shape a V for a long straddle and A for a short straddle. Respond, can I proceed or not? No. Next is strangle. Next is what? Strangle. Everything same, please. Everything same. Call option, put option. Once again what? Call option, put option. On different asset, same underlying asset, same underlying asset. Different maturity data, same maturity data, same maturity. Call and put is on the same share, is having what? Same maturity, but strike price is not same. What is not same here? Strike price is not same. The call option will be having a higher strike price and the put option will be having what? Lower strike price. Like that the strategy comes now is a pattern. All these are like what? Patterns, yeah? Like that the strategy comes. We call that as what strategy? Strangle. How the payoff behaves, you'll see through the numbers. Everybody yes or no? Now. So now tell me, strangle strategy. What are we discussing as? Strangle. In strangle, we discuss about how many options? Two options. What are two options? Call, put option. Same asset, different asset, same asset. Same maturity, different maturity, same maturity. Same strike price, different strike price, different strike price. So how the strike price should be? Call should be having higher strike price and put should be having a lower strike price. Is what we call as a strangle strategy. Yes or no? Now, if you hold such a call and put, I am said to be having what? Long strangle. If I write such a call and put, I am said to be having what? A short strangle. Ennappa, accepted? Can I start doing the problem? Now, take question number. And you have the notes at the end of this step. Okay? Now, take question number 10. Take question number 10. Please. All these we are not inventing. These are well-defined strategies in what? Market, where people trade in these patterns. Okay? Now, can we switch on the AC? Yes, yes. Consider a situation. You will never go home till I complete question number 10 and 11. Please, let us go. That is a stage. Can I say? Now, please. Consider a situation of holding a call and put on the same underlying asset with the same expiration period of 90 days. Strike price of call is high. How much it is? 100. Strike price of put is 90. Call premium 20 and put premium 12. Compute the payoff and the position value for the holder from the given prices on future spot price of 50 to 150 with an interval of 5. Now, make the interval of 10. Okay, now. You can change your interval of what? 10. Change the question here. 5 now it will take full class. Okay, make it as what? 10. Okay, with the interval of 10. 50 to 150 with the interval of what? 10 we can have it. Can I proceed or not? I had defined it. Can I start or not? Now. Let's start doing the solution together. Okay. Please. So make a change with the interval of 10, we can have it. Okay. Same columns, please open quickly. Only change is long strangle instead of straddle. Okay. Fast finish opening the columns, sir. Tomorrow, just a minute, good news. Okay, now. Tomorrow I have the IPCC class, so I will not be having the SFM class. Okay. They will compensate on the next Sunday. Can I say it now? Understand, I only should teach, you only should learn. If not today, it is tomorrow. Right or not? Now, please. Again, tomorrow, no Only SFM and AMA class, not that. Tax is there. Okay, sometimes I never leave. Okay, morning accounts also is there. Okay. Can we start or not? Now. Don't dodge the time here. I know your plan. Can I proceed? Now. I have at least complete this sum. I have reduced the target. Okay, now. Now, 50, please. Shh. Start. You are a holder, writer. So, holder, writer, holder. In a long straddle, not. See, you are having a call option with a strike price of 100. You have a right to buy the share at what? 100. Tell me, you will exercise only when the FSP crosses 100. Yes or no? No. I don't want to ask line by line. Will exercise a call only the FSP crosses what? 100. Till FSP 100, the value of the call is 0. Accepted? Now, put option, what is strike price? 90. I will exercise as long as what? FSP is less than 90. Crosses 90, it becomes what? 0. Right or not? Now, are you following up? Now, let's do it quickly. FSP 50. What the call value? 0. Call value is 0. What the premium paid? 20 rupees. What the payoff? Minus 20. Will I exchange put or not? Yes. I will sell at 90. A share worth what? 50. What the profit for me? 40. What is the premium pay? 12. What is the payoff? 28. 28 minus 28. Next step. 60. Call exchange or lapse? Lapse. Value 0 minus 20 minus 20. This continues up to 100. Can I say? Now, put value. I sell at 90. Share worth what? 60. Profit is 30. Premium is 12. Payoff is 18. What is minus 20 plus 18? Minus 2. 70. Call is what? 0 minus 20 minus 20. 0 minus 20 minus 20. Put will I exchange or not? Yes. Sell at 90. Share what? 70. Profit is 20. Premium 12. Payoff is 8. Minus 20 plus 8. Minus 12. 80. Call will once again be what? 0 minus 20 minus 20. Put will be exercise or not? Yes. Sell at 90, a share worth 80, profit is 10, premium minus 12, payoff is minus 2. Long straddle payoff is minus 22. Doing along with me or not? Now, 90. Call is what? 0 minus 20 minus 20. Put is also going to be what? 0. In a cell at 90, share at 90, no, it is 0 minus 12 minus 12. The payoff is minus 32. Payoff is minus 32. 100. What is going to happen for call? 0 minus 20 minus 20. Now my strike price is 100, so my payoff is minus 20. Put is going to be not in a, once it crosses 90, put value becomes 0. I won't exchange my put. Yes or no? What I put is 0 minus 12 minus 12. What the payoff? Minus 22. Payoff is minus 32. Sorry, minus 32. Please. Can I continue further or not? You continue in the same table. 110. Will call be exercised or? Yes. I have a right to buy at 100. A share worth what? 110. What the call pay value? 10. Premium paid minus 20. Payoff is minus 10. Put is going to be what? 0 minus 12 minus 12. You know, above 90 it is going to be same pattern. Only 0 minus 12 minus 12. Payoff is minus 22. 120. Call will be exchanged up? Yes. Right to buy an 100 share at 120, it is 20 minus 20, 0. Put is what? 0 minus 12 minus 12. Long straddle payoff is minus 12. 130. Call will be exercised or lapsed? Exercised. What the payoff? 30 minus 20, 10. This is what? 0 minus 12 minus 12. Minus 2. 140. Call will be exchanged up? Yes. What the value? 40. Premium minus 20. Payoff is 20. Put is what? 0 minus 12 minus 12. What is the payoff? A. Next is what? 150. What is the value of the call? 50 minus 20, 30. 0 minus 12 minus 12. The payoff is 18. The payoff is 18. Please. This is how the long strand will behave. Can I proceed or not? Now, let's draw the diagram for this next, please. Don't talk, please. The payoff in what? X-axis. Please. This is FSP. Do along with me. This is what? FSP and then payoff. How a straddle looks like a V, short straddle, inverted V. Like that. Strangle will be looking like a tub. Looking like what? A tub. A bathtub we have, no? It is looking like what? A tub. Okay? Now, please. Oh, flower pot. Okay, this one. I don't know. Draw it, yeah? Do along with me. So, there is a strangle. Please. Shh. Now. This is break-even FSP. This is what break-even FSP. I have one number here. I have another number here. Okay. Now, please. This is 90 and this is 100. This is 90 and this is what? 100. Please. Now, and this number is minus 32. For the last having maximum minus 32. What is minus 32? 20 plus 12, 2 premiums. Now, see, put strike price is 90, right or not? Below 90, the put will be recovering my premium. Yes or no? Below 90, I will be exercising what? The put option. So when the FSP is below 90, put will be what? Recovering my premium. What is break-even FSP for put option here? Strike price minus premium. What is strike price? 90. What is premium? 32. What is 90 minus 32? The number will be 68. 58? Huh? Number will be 58. 90 minus 32 gives you what? 58. Approximate diagram. Can I say? No. And above 100, call is my savior. Yes or no? So what is a break-even FSP of call option? Strike price plus premium. 100 plus 100 gives you what? 132. It gives you what? 132. Please understand that at 58 FSP, my payoff is what? 0. Check it. When FSP is 58, all of the answer, will you exercise a call, lapse it, lapse it. The value is what? 0. Exercise a put, lapse it, exercise. I have a right to sell at 90. A share worth what? 58. I make a profit of 32. The 30 will be used to recover my what? Premium. The payoff is 0. Yes or no? No. Below 58, I will be making what? Profit. Due to what? And due to what? The put option. Put holding. Okay. Now. At 132, what happens here? Profit is what? 0. At 132, will exercise a call or not? Yes. Right to buy at 100. A share worth what? 132. I make 32 profit. Is used to recover my what? Entire premium. Payoff is 0. Above 130, I will be making what? Profit. Why? Due to call holding. That means between 58 to 132, I will be making loss. 58 I will be making what? Loss. The maximum loss is what? 32. It happens when? Between 90 to 100 because between 90 to 100, call also will not be exercised, put also will not be exercised, entire premium will be lost. Please tell me, what is the profit range? What is the profit range? Below 58, above 132. What is the last range? What is the last range? 58 to 132. What are maximum loss? 32. When between 90 to 100. Ennappa right or not? Now, why between 90 to 100 loss is happening? Between 90 to 100 FSP, neither put will be exercised nor call will be exercised. So entire premium gets wasted. So that is what is the strangle payoff. Ennappa right or not? It looks like what? A term. Can I proceed or not? No. Write down. No. Up to this I will finish copying up. No. Write down. Have two columns, FSP range, status. Have two columns, FSP range and then status. FSP range and then status. FSP range, right, less than 58. FSP range, right, less than 58. Less than 58. Understanding it or not? Now. Bracket, now how I got the 58? 90 minus 32. Bracket, right? 90 minus 32. So, what is status? Profit. Status, right? Profit due to, reason, due to what? Put holding. Profit due to put holding. Profit due to put holding. Next. Second, more than 132. More than 132. Bracket, how I got 132? 100 plus 32. More than 132. Bracket, right? 100 plus 32. Bracket close. Tell me what is status? Profit. Profit due to call holding. Profit due to call holding. Profit due to call holding. Yes or no? Now, next step. 58 to 132. 58 to 132. Status is what? Loss. Status, right? Loss. Full stop. Continue. Maximum loss. How much is? 32. Maximum loss 32. When? Maximum loss 32. When? When it is 32? When? FSP 90 to 100. Maximum loss 32. When? FSP 90 to 100. When FSP is 90 to 100. Is 90 to 100. Everybody following on?
Thank you friends. OMSAI Bhojanapalli.